Do it. What's going on, people? How's everybody doing today? Welcome to my live stream. My name is Ryan Fagan. For anyone new here, I am broker owner of Artie Real Estate, which is a real estate brokerage here in South Jersey in Burlington County. I've been a real estate agent for 12 years. I've been an investor since 2010, so that's 13 years. I've flipped a couple houses, about six. I have 10 rental units, so I'm a pretty conservative investor. And I've worked as a real estate analyst for a commercial appraisal firm. I've also done over $17 million in loans as a licensed mortgage loan officer. And I worked in property preservation on the Fannie Mae contract many, many years ago when the foreclosure crisis was going on. So we would maintain all those properties and make sure the agents could get them sold or not sold because stuff was having a hard time selling, but we would do the logistics to make sure those properties were maintained in correspondence with the real estate agent. And that's my background for all you new guys here. We are talking about a topic that you may not think matters to you, but it will matter. And that is what I think, and I've been calling for since 2020, is that office real estate is in trouble. I think I get scared to use the word crash, but yes, I think there's a level of crashing that may happen with office real estate. Why does that matter to you? The same reason why, even if you didn't own a house, subprime mortgage lending mattered to the whole country, because there's a whole bunch of cities with a whole bunch of development and a whole bunch of office space. And because of remote work and the way the economy is going, although maybe it's a bit controversial now, and we'll probably get into it, because people are coming back to work. So maybe this crisis may be averted, but we don't know yet. We got to see. Um, but either way, there's a lot of flux with the office real estate market, especially in certain cities. We're going to talk about San Francisco. We're going to talk about New York. And obviously, the headline today is about WeWork, because they would say it's the Airbnb or the Uber of office space, which, investors always want to pile on and want to use a former name that was successful to make something else seem like a good idea. And so we're going to tackle WeWork, which was basically like a co-working or a temporary office space where you could rent it out on a, kind of a flexible basis. And they have recently filed for bankruptcy. And I'm kind of using that as a catalyst to talk about the wider office real estate market and how that is going to affect you, or how it could, because I'm not an economist. I'm just a real estate agent, an investor, broker, owner. And so I just have my own perspective on what's going on. And actually, let me run a test with my audio, because all last episode, my audio through the computer was not going. Oh, let me see. Oh, we're going to get feedback
Last
here.
episode,
Okay.
my audio
Sorry, that's
through
feedback
the
coming
computer was
through.
not going.
Let me see if
WeWork, once a
let me
venture
see.
capital darling, has
Last
filed for
episode,
Chapter
let's
11
see.
bankruptcy.
Sorry, that's feedback coming through. Hey, we're
WeWork,
working. All
once a
right.
venture
Sorry,
capital
guys.
darling, has filed for.
I'm a struggle streamer today. I am struggle streaming. What's up? Talk to me nice. Expensive Acorn. WeWork was pretty cool. Went to the Philly one and was really nice inside. Audio was great. Thank you. I appreciate it. I had to check it myself because, we got a small audience here. But yeah, see, I'm not a city boy, so I don't really live the city lifestyle with everything that goes on. Um, as a real estate agent, I've kind of always wondered, like, what do you do with an office? Like, what do you even need the office for? Because even 10 years ago, you could, a scanning machine to scan and sign documents. You can meet people at places. Obviously, I guess it's a little bit nicer or more professional to meet at the office, but what if the office isn't at a convenient location? And then you got to deal with like the office politics. So I never really loved the office for real estate, but um, with remote work after 2020, obviously, um, like a lot of office space is vacant, and we'll get into the numbers, and I have some of that data as well. But it just is it still going to make sense? I am seeing a resurgence in people coming back to work and then mandating it. Although I think hybrid policies are going to be the standard, so you probably get a couple days work from home, maybe. I don't think that hurts the culture or productivity as much as um, working from home. The other thing, and today is about office real estate, but because people worked from home, the value of homes was up because you were at home more and you needed more space. Kids were doing remote classes and all that kind of stuff, which I don't think, I pray to God they don't bring that back, because I feel like, and I think it's bearing out, that first of all, the lack of social interactions was really bad for kids. But secondly, man, what kind of education are you getting online? It's just not the right environment. But this is a live and interactive show. Make sure you guys are commenting. Talk to me nice, say hello, say whatever your opinion is. If you want to hop on the stream, I will drop the link in actually. I'm bringing up my soundboard.
I like this right
Here
here.
we go. And you can call in and we can hang out because this is casual. Also, it doesn't have to be about the topic. I'll answer any of your business or real estate questions, or we can go back and forth. Maybe a question that you have may be able to help someone else. So in the future, if we can grow the audience, I definitely want to, do some, type of consultation or back and forth and see what kind of gems we can uncover by talking to each other about this kind of stuff. So that is the goals with the live. But for now, I'm just talking about topics that I find interesting and that I've been bumping into. We're going to react to some stuff. I have a Graham Stephan video. Wonder if you guys know who Graham Stephan is. He has 4.5 million subscribers. And he started off talking about real estate, but now he's broadened it to a lot of other topics with business. But I feel like every month he has a video about crashes or real estate crashes with very aggressive imagery and titles, which I get that people do this for YouTube, but I think, especially in the financial space, we need to be a bit accountable for not going overboard, because if you scare people and influence people to make financial decisions based off of, oh, the market's going to crash, and then it doesn't, or you say it's going to go up and then it doesn't do that either, or you're wrong, I think you can really hurt people, especially because in the financial space we do have to understand that regular people, based on the education system, and maybe parents need to take more accountability to this, but the reality is people don't know about real estate, or they don't know about finances, and they definitely don't know about real estate either, because real estate does not work in a common sense way, especially when you're doing mortgages or going through transactions. But I digress. The average person is not well versed on financial matters, and I think we have to all be careful when we're speaking about these things, because families are involved, livelihoods are involved. I think we need to be responsible. I have not pre-watched Graham Stephan's video, so in the third segment we're going to be reacting to it. So we're going to see Expansive Acorn. Yo, where'd you get this name from? Great education online. I learned how to get a multifamily from your podcast. Wow, with the guy who got it with a NACA loan way back. Have loved your content ever since. Dude, I so appreciate that. I was just actually recently talking about, I kind of stopped doing content up until 2020. I started because I feel like we were getting like kind of an audience, and going back to financial advice, I was getting worried. I was like, who really am I to have an opinion or give advice or talk about this stuff? Because I was seeing people listening. And it's so, I really, really, seriously, I really appreciate you letting me know that, because you never know the impact that you're having and if it's positive or negative. So that's super cool. Yo, you must have went. Did you go through hell doing this NACA multifamily deal? And when did you buy it? Because did you buy it during where it was such a strong seller's market early in 2020? Because who the heck was accepting NACA offers during then? You did, man. You must have had a great real estate agent as well. What state? I want to know more details about it. So definitely put it in there. But again, seriously, um, man, I really appreciate that, because I've been like, since I've been resurging back and trying to do content again and resurrecting the YouTube channel and just putting myself out there after kind of taking a sabbatical from actually, like, in real life, I was not working with buyers as much. My whole career was based off of helping first time buyers and, getting, because I was very educational based, and I still am, trying to educate people on the benefits of home ownership and like this deal that you're able to do with NACA, the multifamily. Um, Once the market turned and got kind of challenging to even service those people, the passion for it, because that was my why, right? Like, it's important, especially in my position where I'm kind of like hit financial freedom, which it's weird. We got to do a talk about this, as far as, um, it's kind of a gift and a curse, because it hurts your motivation when you don't have to do stuff. So, it's probably something that I want to talk about as well. But yeah, basically my why was kind of, you know, erode it, because the first time home buyers getting people into their first house was not happening. I was driving around showing people stuff, and I felt like a doctor that kept telling people that they had cancer because their offer was not accepted. And I could see the sadness in their eyes, and I hated giving them that bad news. And it really had a toll on me, because as you know, hardcore as people think I am also empathetic. And even though I might hold people accountable for their actions, I empathize, with the people trying to come up and trying to do better. And the last 3 years has been really challenging with that, and it's been demotivating, because my motivation was, the closing, getting people to their first house. And obviously, as a real estate agent, that's probably where you make the least amount of money, but that's where I got the most life from. Obviously, as a business, you want to do higher luxury, et cetera, et cetera. And, we're trying to go that way with the company, but my passion is always going to be educating people. Expansive Acorn. No, I didn't end up doing NACA. I did an FHA in July 2020. Wow, for a triplex in Philly. Keep putting the stuff up, man. It's helping people for sure. Yeah, I really appreciate that. And wow, dude, I'm trying to keep my cool, because I'm here on the live and I'm just getting started. We haven't even gotten into the first segment, really, in the introduction. But if I really dwell on this, like, it's really impactful, because, if you can help someone in any way, and I know, if you bought this triplex in Philly in 2020, you have a bunch of equity in the property. You probably might be able to flip it conventional and get rid of your mortgage insurance. Well, not now because of the interest rates. Okay, so yeah, scratch that. Sorry, but you have a bunch of equity in the property, and you're probably cash flowing quite well. And now my question to you is, what are you going to do in this current market? Are you have you overgrown the house? Like, what are you thinking about doing in the future now that you have such a great springboard? Because, man, and if I was able to contribute in any way, that really matters a lot. I'll probably, when I go to sleep tonight, I'm like, wow, you know, I don't know. I get deep about it. Like, I started making all these connections, like, 2.25% interest. Did you get a buy down or something? That's crazy on that. But yeah, seriously, like I always think about, because money and all that stuff is cool, but impact is super important. And sometimes, you post something, you get 50 views, but I even on content where I've had low views, I've actually had people reach out to me. I used to put my phone number in the video, and I remember distinctly one time I had a it was a kid that was going to Camden Rutgers. He was going to Rutgers Camden, and he was talking to his family about buying a duplex or a multifamily and then going to school in the area. And his family was very much against it. And that was a moment that really scared me, because he was really looking for my advice. And, I don't know your life. I don't know what you got going on. I don't know if you're equipped to execute on the thing, and stuff can go wrong. But I do believe that getting a multifamily for that person was a great thing. So, I try to give the pros and cons rather than just say, hey, I think you should do this. I feel like you have to take responsibility a little bit if you give advice for the results, which people disagree with me about that. That's why this DJ Envy thing and Caesar scamming bothers me so much, because he was out there preaching all this stuff, and come to find out he was leading people to get scammed. But I just think that's got me afraid, because he really was looking for my opinion, and I feel like he was looking for an like an approval to pull the trigger on the deal. So it was a quite concern. Like, it was concerned. It was scary, and I think some people would just like that, but I don't know. It was a bit scary. So, but I've come to a new mental place about all this stuff, and I think that I have more experience. I have more wisdom, and I'm in a better place about giving advice. And so I'm pretty confident about being consistent going forward. And I don't mean to talk about myself, but you got me talking so much about, uh, my own perspective. Expansive Acorn said, I'm not buying anything. I still live here and love the house. I mostly do stocks, and now just bought a Turo car. None of the houses near me make sense yet, but I always keep looking. So that's the funny thing. We're kind of in a similar boat, right? I've been looking at stocks more, because you're not getting beat up on the interest rate. But actually, I'm just looking at some CDs and savings for certain allocations of money, just for some balance and for a rainy day in case things change. The Turo thing is cool. I think it's kind of risky, but it's a cool thing that it's not a huge investment for you probably. So it's probably pretty cool to get your feet wet, and not super time consuming. So that's pretty cool as well. What else? Oh, but I was saying, I have some properties in town here. I'm here in South Jersey, near Mount Holly, and I look at what my homes are worth, and then what the rent is, and I calculate if you were to buy them at market value. I mean, they don't make money, right? So a lot of stuff doesn't make sense right now between the price and the interest rate. So definitely like stocks. I'm trying to get the real estate brokerage business going. So if you know anyone looking to buy or sell here in South Jersey, definitely send them our way. I was talking to my team last night. I'm like, but who's buying and selling right now? So it's like divorces or relocation where you really have to move, or you just had triplets and your house is too small now, or you had kids. I'm joking. But it doesn't really make a lot of sense for people to buy or sell in this environment. Obviously, the only time it does make sense is life changes. So that's what we're dealing with. But I will say, if you don't own anything, it probably still makes sense to buy something. But don't take generic advice online. This is why you need to do a consultation. You need to talk to professionals, run some scenarios. That's the best thing about real estate, is you can look at what the payment is, what the potential rent is, what your 3-5 year plan with the property is. And it's not that risky if you do your proper strategy, and it's not rocket science, but you do need to consult with the right people. Don't just Google, don't just watch podcasts, don't just listen to people because people are saying anything, which goes to the Graham Stephan video, because I don't know if I'm going to agree with them or not, or we'll see. He always does a really good video with the data, so that is one good thing, but I don't like how he packages the information. Expansive Acorn. Yeah, people will always be buying and selling. Sure, it's slower, but I'm sure you are farming your area and doing a great job hustling and getting market share. We just started in the summertime, so still getting everything going. Plus, my momentum has been down since I kind of have been taking a step back, so I'm trying to revamp and build everything up. If there is a divorce in South Jersey, I hope they call you first. Is that toxic? Like divorces, man. I told somebody, I think I told my team, I was like, man, divorces, you make a lot of money as an agent, and that's nasty, and I don't wish that on anybody, but you do. And if you didn't know, I'm a big advocate for men and women to get together. I know I'm still a single guy. I'm not a city boy in the lifestyle sense, but maybe I was in the different sense. So, I'm trying to figure that out as well. So, I'm on the market. Anyway, let's get into this first video about WeWork, and we're going to see. Let's see what's going on. It's going to give you some context. And is this New York Times? All right. So, this is Wall Street Journal. It's fair use. Y'all need to stop copyright claiming, because it's fair use. I'm providing commentary, additional information, and this work is transformative, meaning I'm not using your work without the proper commentary, educational devices, et cetera, to make this, a copyright claim. So stop doing that. I have to keep fighting these guys on this, but we are here to educate, so I will take the risk and see if they demonetize, which, we're not making any money yet, but it's the principle, I guess.
The filing marks a stunning reversal for the desk rental giant that was once valued at $47 billion.
WeWork was the poster child of the unsustainable startup frenzy of the 2010s.
A rise and fall so dramatic, it was characterized in an Apple TV series.
What?
Who wins in a fight? The smart guy or the crazy guy?
They got no. That's crazy. I see, that goes back to this copycat thing. They were like, the pitch men who were selling the show were like, it's going to be like The Social Network, but about WeWork. And someone bought this. Apple TV has been desperate. They don't have good content on their platform, and no one knows about it. So I think that's what's going on there. Anyway.
Are you crazy enough? I may be.
Here's how WeWork went from being one of the country's most valuable startups to a
billion.
bankrupt penny stock, now worth a fraction of its peak
Down
value.
to 44 million.
WeWork, co-founded by Adam Newman, specialized in leasing shared workspaces in metropolitan areas around the world.
We're a company that builds.
Expansive Acorn. You got to come to one of our Artie real estate mixer events, which brings real estate professionals, anybody interested in real estate, together to network. And it's a chill vibe. It's not like stuffy. We have a really good time, so you should check it out. Hit me up, I'll send you the info. Actually, we probably won't have one till spring, but still, hit me up. I'd like to hear more.
Communities. We have our mission, our main thing.
Sorry, because we're trying to build community so that when maybe you see a deal but it's out of your scope because it's too big, we're trying to get some scale together. If we can come together and buy stuff together, larger properties, there's some benefits to that on the lending side and on the municipal legal side. Plus there's the benefit of scale with sometimes with the rent or having multiple units. So that's something to consider. I've been working on that. It is hard to collaborate and work with people, but we have been trying, and I've been trying to figure that out, because that is the future, is if we can pool our money together to do stuff. I'm not saying don't pool all your money, but you take 25, 10%, strip off some of that stock portfolio, and let's like do some kind of joint venture or something like that. I think it's a pretty cool concept, but we got to put it together. We got to make sure that our interests are all aligned, and we, you know, there's a lot to working with other people and doing investments, especially real estate investments, because they're illiquid and you won't see your money for a long time. So this, you got to be careful, but we want to do it in an ethical way where everybody makes out. So that's I do think that's the future, though, is working together. There's no way we can all do it on our own. Yep.
That we do is curate and create culture.
WeWork was founded in 2010, right after the global financial crisis, and it basically seized on this casualization of the workforce that was emerging after that.
WeWork raked in funding from a roster of major investors, from venture capital firm Benchmark Capital to banks like JP Morgan and Goldman Sachs.
I need to get some of
The
this
founder,
money.
Adam Newman, was able to convince all of these people that WeWork was a disruptive tech company.
How did they do it?
That was going to do to the office market what Facebook did to sort of social media and what Uber did to transportation. They ended up raising over $10 billion for what was effectively a real estate company worth a lot less than $10 billion.
In 2019, WeWork hit a peak value.
See, the funny thing about these Silicon Valley valuations that I've realized is they're based off of crazy projections. And I mean, when they're right, like Uber and stuff like that. So they do really well. But for example, Tesla has been always beat up about this, right? Because on CNBC, they would always try to scare you and sell your Tesla stock many years ago. Now they love it all of a sudden. But they were like, this valuation makes no sense. It's valued way, way, way more based off of every basis or metric that you would calculate for a auto company. But the counter argument is, well, you're not valuing it like a tech company. And that's the problem that happens in Silicon Valley with this WeWork thing, is that they're valuing this company not as a real estate company, but as a tech company that has super growth potential and all that kind of stuff, which can work out. But in this case, it did not, because 47 billion, woo!
Valuation of $47 billion and took steps towards an initial public offering.
At the time, the private tech startups were seen as this really sort of powerful engine of the future economy, and there was a lot of optimism about them. So they get ready to go public and sort of reveal their numbers to the world, and people kind of wake up.
While WeWork's revenue was growing, so were its expenses. Despite raking in billions in funding, WeWork had yet to announce a profit since its founding in 2010.
And there were also all of these conflicts of interest and related party transactions that are really concerning for investors in the IPO documents. So Adam Newman owns stakes in 4 buildings that he leased to WeWork. And so he's on both sides of those deals.
On top of concerns about WeWork from public market investors, questions over Newman's leadership style also threatened the company.
Adam Newman had this really chaotic approach to management. One day he would decide that 20% of the staff, the bottom 20%, needed to be fired every year. Adam was...
I worked at a mortgage company that would do that if you were ranked. The problem is their metrics were messed up. Like their analytics people couldn't do math, but they would fire the bottom 10% every quarter or whatever. So if you ranked at the bottom area, you'd be out of there just because. And then it'd be confusing because then they're bringing in new employees, which is crazy. But the mortgage industry is like that. Like you make a whole bunch of money and then you don't make any money. Then people get laid off and they get fired. And then they go to the other similar mortgage company. Like everyone just bounces around. It's a really small community.
Really into spending in all these eclectic ways. They had a small unit in WeWork that was making self-driving robots to go around and drop mail off at people. They bought a $63 million jet that Adam directed and was a huge fan of. It was just like one excess after the other at its peak.
Yo, do you guys watch the jet business? That's his Instagram handle, a guy that sells private jets. That is the best sales guy that I know. You guys should check that out. I just like how he runs his business, and learning about private jets is pretty cool too.
WeWork ultimately pulled their 2019 IPO, and shortly after, Newman resigned as CEO, walking away with more than $1 billion from SoftBank, a tech investor that acquired WeWork.
It was such an extraordinary amount of money for someone who had actually really destroyed so much value after creating it. I think that's
that's the thing about society that's really frustrating, is like, however these people are plugged into the world, like, you get $1 billion for effing up and messing things up. Like, you get money for failing. Meanwhile, the mechanic down the street makes one mistake. He's fired. He's gone. He can't pay his rent. His girl leaves him. He gets kicked out of his house, gets evicted. I don't know. It's funny because I'm trying to be more of an elitist. I've been getting criticized because I need to elevate or whatever, but I feel like I'm a man of the people, and I don't know. It's really hard for me to change my thinking about that, because I have like a low level of disdain for the old money people, or people that are gaining undeservedly. And I think people could look at me like that, but yeah, I guess it's a chain that goes up the chain. But I don't know, these guys that fail, all he did was convince people to give him money and then try to do a business, and it never worked. I could do that. Give me $47 billion. Or he didn't get 47 billion, but give me $1 billion, give me a couple $100 million. I could make a business that actually works.
A stain that still stays with him. When you sort of mention Adam Newman and WeWork, people often say, like, isn't that the guy who got really rich while investors lost everything? And that's accurate.
Wait, you
Chapter
think
11 bankruptcy, the filing.
Oh, I messed up again. You think the jet business guy's interface is bad? It seemed pretty cool to me. I don't know. I was impressed, but I don't know. I don't know nothing. Now I have to find my spot.
WeWork from public market investors.
The chaotic approach to management. One day he would decide
that hold ways. On. You gotta find it.
Shortly after, Newman resigned as CEO.
Amount of money
he's failing up.
Okay, not long after Newman's departure, COVID-19 spread across the globe. Demand for office space decreased, rent dropped, and WeWork's entire business model became its own Achilles heel.
So they just have these rents that are from a different era that they're paying, while their tenants are paying them a lot less. They have been burning through $300 million a quarter of cash 4 years after pledging to restructure, to rationalize. It's just completely untenable.
WeWork filed for bankruptcy barely 4 years after the company reached its peak valuation, and more than 2 years after it went public under new leadership in 2021.
The tank of cash that once overflowed ran out. They were never able to make a profitable business.
Yeah, that's the thing that's pissing me off, is these guys are getting money and the business don't even work. There's 1 million people that have a business that works, right? And they don't get funding because they didn't go to the right school and they don't know the right people. We got to fix that. We really do. Like, we got to build local business organizations where we meet and share information, and not in that old money way, right? Because the Rotary Club and stuff like that, like, is very elitist in there. I don't know. We're trying to develop that. That's what we're doing with the real estate mixers here. If you're in the South Jersey area, hit me up, because I don't know. There's unlimited money for these guys just to throw away at businesses that don't work, and it's pissed me off.
It's an extraordinary tale in that they raised over $16 billion of equity and debt.
$16 billion!
But this may not be the end of WeWork's story.
The business will likely go on. They're going to need to cancel a ton of leases, cancel their debt, and presumably can come out of this a real business that can make money. They have some locations where it's profitable, but it's going to need a lot of work in bankruptcy court to get there.
So do you guys think that WeWork is a good business model? Because there is an argument that not everyone needs dedicated full-time large office space where, you know, but you might be able to share or just rent it temporarily. A lot of people have side hustles and odd jobs and stuff that they're doing. But is your business, see, it's a weird sweet spot, because if you're not making that much money, why the heck am I paying for office space unless it's my own vanity? But if I'm making decent money, wouldn't I want like a dedicated office? Why would I want an office sometimes? I don't get it. You know, I don't know. And I've been in some of those spaces. I've had some meetings in them, but I'm like, do you guys really come here? Like the co-working spaces, like, but to their argument, I mean, at least you're around other creators. If you're in a co-working space, you can mingle with them and hang out by the coffee machine. And I think there's more value in that than actual like office to be an office. I think it's the people that you meet, and that's something that I've been learning is that's really where the benefits goes. So this is basically like just a poorly ran business story, but I do think it's exacerbated by the decline in office space demand. Let's see if I have another video that hopefully will give us some more data. And this is a CNN video. Fair use, CNN. Don't play with me. That's that. Okay, so the thing that sparked this idea is obviously, again, we talked about a remote work, you know, all that kind of stuff where the world has changed. These businesses need way less space. And if WeWork is leasing your building and then they declare bankruptcy, now you have vacancy. You add on top of the fact that people need less office space now. What do you do with the building that's set up as an office? What does that do to the economy? And back to my subprime mortgage point, if it's enough of it, could it cause a cascading effect that affects everything else? Because if you have a bunch of office space and then they're defaulting on their loans, they can't make interest payments. Lending is a little bit more challenging. If you have to refinance your loans, it's going to cost you way more. And so if you end up with a higher financing cost, AKA more monthly payment, and you can't rent out your property because no one wants to rent it or they'll rent it at lower prices, what happens? What happens to the market? That's what we're going to talk about.
After decades of booming growth, the commercial real estate industry has run into a
fair
brick
use
wall. Building values are plummeting, offices remain empty, and now rising interest rates could put pressure. The industry could pressure the industry even further. CNN's Vanessa Yurkevich is here with more.
All right, Vanessa, let us know.
They're statuesque, vast, and staggering, and they're empty. Skyscrapers and office buildings once stacked high with businesses are...
See, that's the thing. Imagine these big ass buildings and half of it you don't need no more. So set up the way that it is set up for office space.
Experiencing high vacancy rates in the U.S., nearly 19%, 5.5%.
19% vacancy rate, meaning 20%, basically a fifth of this building is empty.
And higher than before the pandemic.
I think it's a very unique moment, nothing like any disruptive marketplace that I've experienced over the past 40 years.
The pandemic emptied offices around the country. Today, the number of people returning to in-person work is less than 50% in 10 major metro areas.
But let me check the date on this. I know it was pretty recent, I believe. It was 4 months ago. So, I mean, it was pretty Still pretty recent to the market. And then Expansive Acorn said, I'm on the yard, but the jet guy shows the simplest thing with 4 inputs like distance and size. For WeWork, it makes sense for organizations with variable staff size. True. Like in consulting, client site, home, but need a third place. True. It is nice to have a separate office, though. It really is. So this video is pretty current.
Forcing companies to rethink physical office space. Half of the biggest global companies say they'll need less real estate in the next 3 years.
Okay, and that is the thesis for everything that I want to talk about. 50% decline in office demand, meaning every single office building that you see, half of it they don't need. Now, my thought about this is that they would convert it over time into condos. So you might have a mixed use. It might be office space in certain areas, certain parts of the building, or certain floors, and then other floors are apartments. But that would take a long time. And who's going to finance or pay to convert them? In the meantime, what does that vacancy do to the banking system? What does it do to the companies? And how does that trickle down into residential? Assuming that they convert 20% of it into housing units, condos, whatever, that could be really good for home affordability, but it could bring prices down slightly in cities because a whole bunch of inventory becomes available all at a similar time, which I think is good for the people, but it would destabilize some of the markets. And now you get falling prices, especially in cities. I don't know if this is much of a problem in the suburbs and all that, which we're going to talk about, the forgotten city of San Francisco that has been ran into the ground in a little bit. But let's continue for context.
Leaving landlords with loans to pay in a bind.
If there's no tenant, you're not making money.
Right.
What do you do?
There's no recouping, lost income for downtime.
Stephen Durrells runs the leasing at SL Green, New York City's largest commercial landlord. With more than 30 million square feet of space to rent, the collapsing demand for office space means their tenant vacancy rate shot up from 3% pre-pandemic to 10% today. That calls for some creativity.
You can build the set in here. You can have a fight scene in here.
SL Green is now working with Backlot, a company that connects landlords at 332 buildings across New York and New Jersey with film and TV companies. This episode of Law & Order was filmed in this vacant office in Midtown Manhattan. The Watcher on Netflix and these East Side offices.
I think.
See, this is why the CNN, that the news is stupid, okay? Because guys, like, what? That's not a solution. That's like that they say stuff like that to get your attention, because how many people are shooting videos that are going to use these elaborate offices? Yes, it's a cool idea and it's interesting, I guess, but like, get down to the nitty gritty about what's the ramification, like what's going to happen. Don't give me this Hollywood BS.
People are starting to look holistically at how they can support a revenue stream.
This year, SL Green says it will earn
$3
million from film and TV shoots.
It's really helped
$3 million. That's it.
mitigate the loss of income during the downtime periods.
Empty office buildings could be turned into residential, a big need.
Go Eagles.
This project in Washington, D.C., once an office building, is being turned into apartments.
There it
That's
is.
not an easy, quick fix process. Less than 1% of apartments nationwide are converted from commercial properties. And across the river in Arlington, Virginia, the city is trying to get ahead of its empty office space.
Oh, we got
problem
Expansive
at
Acorn.
22%.
I'll bring you on in
I'm sitting right today in Northeastern's
2 minutes.
DC campus. Last year, university was not
Actually,
allowed.
screw it. Let's pivot. Hopefully your stuff's on, because we have someone that purchased a triplex in Philly after watching the podcast, Expansive Acorn. And Let's see what he has to say. Hold on. Let's see if I can do this. Technology. Can you hear me? Oh, he's muted. Can we bring him on? How does
I
this
can hear
work?
you. What's up?
Yo, man, what's going on?
It's going great. How are you?
Good. You're on the live. That's crazy.
Man, pleasure to speak with you, bro. I feel like I'm talking to a celebrity.
See, now you gotta go and do that. Don't do that.
No, serious. I remember watching a bunch of your stuff, so this is an honor, man, for sure.
Well, I appreciate it. I guess, can you give me your perspective on like what happened with the purchase and everything? Like, what do you do? Like, give us some background.
Well, me?
Yeah.
So I don't know. I'm from Philly. Been here a long time. Went away for school. Came back in 15, working consulting, and then just read a bunch of blogs and stuff saying basically save your money. And that was good because I had enough money when it came down to buy a house with my wife to do it. And then it was fun getting her on board, living in a multifamily. It's not easy.
How did that go? Because I like show houses to usually it's single women actually that like they like the financial aspect of the multifamily, and then I show them the multifamilies and they're like, no, it's not gonna happen.
Yeah. I mean, we saw probably in person only like a dozen, which is only, I mean, depends on who you ask if that's a lot or a little, but we saw a dozen in person. And then we looked at probably like hundreds through spreadsheets and stuff online. But it really depends on what the house looks like. Like we were able to find one that looks like a regular house. It doesn't look like, a multifamily. So she was about it. And it was, the units were pretty newly renovated. So it was easy because we lived in an apartment before. So it's kind of like, let's live in an apartment, but we own it. Yeah.
Now, were you going through the NACA program at first and then got tired of it, or like what?
No, so for NACA, like the video was great because I think like your dynamic with the guest, if I recall correctly, was really cool, and it was good. Like I forget the guest, but he had this real like hustle mentality. Like I'm just gonna get it, credit cards or whatever. I'm just gonna get it. So it was more that because when I tried to go through NACA, I couldn't go because of my income. Like I didn't qualify, which was true for a lot of the programs. Like, I was lucky enough to have a good career, so I didn't qualify.
Right. Yeah. You said consulting. I figured you probably make a good amount.
Yeah. Life is good.
Hey, so I guess, so what happened with the financing? So you ended up going FHA. Any notable issues or things that you dealt with that?
So I was open to both. I mean, like I said, I was preparing for it for a long time, like watching your videos, watching other stuff. So my credit was great. I had, enough for like full conventional 25% down. And I knew the area well. So I didn't have any like hesitancy. But no, I mean, we put offers on houses. We got declined, conventional or FHA, always flexible. Got declined for a bunch or just got outbid. And then this one that we ended up with, we kind of just walked in and like within 30 seconds we knew. We had just changed real estate agents actually because it was during the peak of COVID. Our previous real estate agent, declined showing us any more houses because there was a scare like losing your license and things like that for showing houses. So we had just changed real estate agents like 2 days before, and then that guy got the commission. So it's unfortunate, but
shoot,
that's how it worked.
So March, April, May, June. Okay, so
yeah, so we put an offer on Memorial Day weekend. We didn't close until July because they had a contingency to buy another property and move out.
So it's weird because when I think of the COVID market, I think of it as a crazy seller's market. But that window that you're in, everybody was scared. So people were like, I better sell it now, because a lot of people thought everything was going to crash because in New Jersey, they banned us from showing houses like straight up for a couple weeks. And I was like, this is not going to work.
It was right during that time. I think we got lucky. We just had a guy who didn't care, I guess, or whatever. He understood the risk, but he was willing to show us. Yeah, we saw 3 houses. And we walked into it and we knew. I mean, my wife knew. She walked in, she saw it, and she was like, yeah, this is it. It looks nothing like any other triplex we had ever seen before.
It wasn't like, because in a lot of multifamilies that I noticed in Philly are like row homes that are converted, but it doesn't make sense because the layout and all that. This was like designed to be a triplex.
So it was built as a duplex with like a wet bar in the basement, and then we converted that to the third unit.
Oh, you did the conversion.
Yeah. So we bought it as a duplex. It was zoned for, well, it was zoned only grandfathered in as a multifamily because it was originally built as a duplex. So we got lucky there as well. But from the front of the house, it just looks like a regular house. It's detached. It's in, an area in Philly where, a lot of the homes are like that. So yeah, it was good. And then it met the 1% rule. So I was happy. And the unit that she wanted to live in was great. So she was happy and we didn't have to pay the mortgage, right? Because we've got tenants in as soon as possible.
Can I ask, like, what was the scale of the purchase price, like around?
Yeah, I mean, I don't mind it. I'm anonymous on here, so nobody cares. Nobody knows who Expansive Acorn is. So we got it for $315, and we estimated rents for all 3 units. We were going to live in one, but if we were to rent all 3, which is how we ran the calculations, for $3,600.
As you should.
Yeah.
Nice. Yeah. Okay. Yeah, because you would always want to assume that you're going to move at some point, right?
Yeah, but we messed up. We fell in love with it, so it's like now we just live here. I got a second property, but that was not on purpose. Some family stuff had to make some transactions there. But so I only have 2 properties. When at this point, if you'd asked me in 2020, I was going to get like 1 a year. Like the whole, you're going to get 1 a year. You're going to move once you meet the 1 year for the FHA, and then keep building. But it didn't work out that way. But we're really happy here, so it made sense for us.
Nice. Do you do your own management?
Yeah, I mean, I'm here. It's funny. Just like a couple hours ago, my tenant texted me that their washer. It's being a landlord.
Yeah. And see, it's funny when I got my fourplex in Texas. I never managed it because it was already under a management company, and she was like, "You should probably let us keep doing it." And I feel like it was the best thing ever because the tenants thought I was just a tenant too, so they never bothered me.
Very great. I mean, they don't knock or anything. They're really cool. So
Right.
I do have a question for you, though. Maybe you can help me out. So I'm having a problem that so my tenants moved in basically between July and like September of 2020, and so since then they were at market rents at the time, but I haven't touched the rents since because they've never been late. This is the same tenants. They've never been late. They're great. They on average call me like once every 6 months, maybe. So it's just been really good. No complaints for noise, nothing. So it's like I feel great about it, but at the same time, should I be more policy driven and be like, well, it's been this long, rents are going up, kind of thing.
Okay, so I'm controversial here, and everyone gets mad at me. But there's a caveat because you live there. The devil that you know is better, and obviously they're not really a devil, so that's good. I'm an advocate though of keeping your rents at market because to me it's a business, and you should always raise the rents when you can. But because you live there and they don't give you a headache, I'd probably be less aggressive with it. But I would like, what's the rent and what do you think it would rent for today if you put it on the market?
So between the 2 other units, I mean, they're pretty similar. They're like 1-bedrooms. I would say they pay about 1,000 for 1-bedroom units in Philly. I think market's probably like 13, 1,400.
Yeah, I was gonna say 14. If you didn't live there, I'd aggressively try to increase the rent.
How do I do that? I've never done it before, right? These are my first tenants.
I don't know what the PA laws are, so I don't know what your rent like maximum. See, New Jersey's strange. So here in New Jersey, the case law basically just says like it has to be reasonable, but I don't really know what reasonable means. So we kind of wing it on the amount. I try not to just do more than 200 based off of like a normal, if the rents, the rents here are like 2,000. So, going from 2000 to 22 isn't that crazy. I don't know what the law is over there in PA. if it was me, I'd probably do like $100. But you mean like how you actually do it? Do you have a lease?
Yeah. I have a lease. It's extended month to month now because they've been here for so long. But yeah, I have a lease, and in that lease, it is a 60-day notice of increase or moving or request to move. So
Okay. So I like to do it on the lease renewal. I don't like to leave them on month to month. I like to send a new lease over with the 60-day notice, and then have the different the rent increase in it. So,
beautiful. Okay. Yeah, I can
and then
probably do that.
and then what I do is if they want to stay month to month or a shorter term, then the rent for that would be more. Right. So I'd be like, well, if you want to stay on month to month, it's going to be 14.
Okay. Yeah.
Now, I don't know if you're allowed to raise it like that in PA again, because especially Philly has like a lot of like, it's kind of like Jersey with the landlord laws and everything. So I would just look that information up just to make sure you're not messing up. But I always do it in the lease renewal.
That's good, man. That's good advice. I think that would have been the avenue if I hadn't, because I did full year renewals for like 2-3 years, and then dropped it recently. But I can always take that step first, like performing the lease renewal, walk them through it, because it's a good touch point to talk about those things. Makes sense.
Right. Yeah.
Yeah. All right. Very nice. Thanks for the
So-
advice. I'll let you know if it works. Like if you ask me right now, I'm just not interested in raising it because they've been perfect, right? You have perfect attendance. Like I'll honor that much more than ever having to reach out to them to be like, hey, rent.
True. I don't think $100 is going to hurt them. You get 200 more net, and they're still getting a discount. See, that's the thing too. Is like if they're happy where they're at, they won't really understand that the market rate has gone up, so they could be upset. But just my personal opinion about it is, if I would you give $400 or what would you? So if it was 14, you're leaving.
No, you're right.
$800. You're
Yeah,
leaving
yeah.
$800 on the
Like,
table. So that's literally like you're giving $800 a month away.
Yeah.
Charity.
You're right. I think about that all the time. But like I said, I mean, financially, it's still producing tremendously, like the property itself. But you're right. I mean, there's
Don't
money
be
on the
scared
table.
of your tenants.
Yeah, that's a good call.
But so this is the weird thing with advice that I was talking about, right? Because I'll tell you that you raise the rent, they leave, and then the next tenant comes in and is a nightmare. Like that can happen. So I get it, So I see. This is where I go on both sides. But me, I've been raising my rents. That's what I'll say. And if they want to leave, then I'll get a new tenant. And I mean the market for tenants. I mean, I list something for rent, and you get 1 million inquiries now. Half the people aren't qualified, but you just need to screen.
I'm with it. I'll take that. I'll take note of that.
One more thing, when you bought the property, had you planned to convert it into a triplex or add another unit?
For sure. I mean, it was a really easy conversion. Like we just didn't like the floors down there, and then since it was a wet bar, like it already had a sink, bathroom, washer dryer down there. Only thing we had to do is floors and put an electric stove in there with the 220 volt or whatever it is.
Gotcha.
That's it. It was. I don't really take credit for conversion. I guess the previous owner used it as a family room or something. I don't know, but
well, did you have experience with like hiring contractors or like this kind of stuff? No, not at all.
Nothing. No. No, I mean it was a pain, like going through it and everything. Neighbors complaining about loud noise and stuff. But it was tough at the time. But
you didn't have trouble with the contractor or anything.
What does trouble mean? I mean, they took longer than I expected, and
they don't show up, and you paid them money.
Oh no. So I think the way I did it was like half, and then I bought the materials. But they didn't. They came
half is
in.
a lot, though. I want to do that.
Yeah, but they came in to do the work on the day I gave them half. It wasn't like they quoted the work, I gave them half, and then they came in. You know what I mean? So like they were half done or not half done, but in progress. Gave them half, and then came and finished that. But yeah, there were times I'm calling them every like Saturday morning. You said you were going to come. Where you at? Kind of thing. Yeah, for sure.
Yeah, because my thing is you never want to be upside down in the job where you paid for more work than has been done. And I've learned that over time because like I'll have a good contractor, no problem, no problem. And then all of a sudden, I don't know, the child support come and they just stop showing up. And now because what a lot of these guys do is take that half and pay their bills with it, and then they can't finish. But you are buying the materials, so that kind of helps too.
Yeah, it worked out, but I'll take that advice as well. I haven't found a good GC at all. Like I always hop between them, so I've never had a job done so well that I was like, yeah, this guy I'm gonna hire back.
Interesting. It's really hazardous, man, because I have a lot of experience with this, and it's still problematic at times. That's why I was asking.
Yeah.
But dang, you made out, so you didn't have a problem.
I think my problem with GCs, and when I'm honest with myself, is I think I'm just too cheap when it comes to it. Like if I upped what I was willing to pay, I think it would open my pool to like just a greater amount of GCs, because I'll have 7 people come and give me quotes. Only one of them's in range, and I'm really tied at that point, right? Because if I like the character or not, I can't really judge their previous work, because it's like you're the only guy that I can hire, right? Within
Right.
budget.
Yeah, and you will get a wide range of prices. It doesn't make sense, but yeah, that's how it goes. Yeah, dealing with contractors is like it's an art and a science. So
Yeah. But I mean, since this property, I've just been taking it really slow. Like, yes, I mean, I look all the time. There's probably like 3 properties between then and now that I was actually serious about putting an offer in. For whatever reason, they didn't work out. But that's it. Like in 3 years, 3 properties. Everything else, the ratios just didn't make sense, or like they weren't zoned properly in Philly, or for whatever reason, it just didn't make sense. I mean, the capital was there to make the deal, but they don't make sense. And if they don't make sense on paper, they're not going to make sense in real life, at least in my head, right?
no, for sure, don't force it. That's me. I haven't done anything in 3 years. We bought a flip, but that was off market, and it like was a great deal. But anything on market, I haven't seen a deal in 3 years, basically. But I'm not like I don't run like a wholesale thing where like I'm finding the deals and doing all that. I always buy from the MLS. Trying to change that probably because that's where you really make money is getting the deal. Finding someone who is in distress that wants to sell it, but it's just not my style. So
Yeah. I mean, it's different for me because I'm not in the space. Like it's not my job, right? Like my primary income is not real estate. I don't think it ever will be. So it's easy for me to just kind of park it, just not even think about it, or let Redfin send me every once in a while like houses that come up.
exactly, yeah, it makes sense. This is the perfect case study for what I always like advocate for is what you're doing, right? Like you're not trying to be a real estate person, but making a smart real estate purchase, um, is beneficial. I'm sure you're glad that you're getting the cash flow and you still like where you live. So, I mean, how can you beat that? If you had rented, I mean, think about what the financial situation would look like.
I mean, I love renting. Don't get me wrong. I love renting. So like I think about it all the time. I would still have 60 grand in my pocket that I didn't spend on the down payment. That's for sure.
Oh, you put that much on the down payment?
Yeah, because it was 3.5 for the FHA, but then it's like 10% gets you PMI to drop in 10 years, or not PMI. It's like
Oh,
MIP
you
or
did
something.
that.
But yeah, so I did 10% on the FHA, and that gave me the low rate. And then yeah, after closing and everything, yeah, it was like 59 or something.
What do you think the house is worth now, though?
I don't know. I mean, Zillow or Mint is where I track the net worth, so that shows me the house, and that says like 405, which I'm cool with.
And you were in it 350, 315? I forget.
315, 315.
315?
Yeah.
Well, that's nice.
Yeah, it's good. It's
Plus
good.
you got the pay down.
Yeah, but I mean, I don't look at appreciation really. I don't know how you feel about it, but to me, it's like appreciation is like a ghost metric, because sure, the
Yes.
house goes up, but then the house you're going to buy when you sell this house, especially for primary residences, it doesn't really matter. Like, who cares that my house went up from 250 to 700 if the next house I'm going to buy is going to be 800?
Right.
It's there. I get it, but it's not all that's correct.
Well, I wouldn't sell it to leverage into the other house, especially because of the rate, right? It just doesn't make sense.
Oh, this house? Yeah. You should have
But
seen
you
me.
know, but like, see, I mean, I wouldn't recommend doing that. But I guess the appreciation can benefit you because you could do a HELOC against it if you had some kind of investment that you wanted to make, or like. But I mean, if you're just working and stuff like that, I see what you're saying. Like, what are you really gonna do? Equity is imaginary money because you don't have it.
Yeah, yeah, and you can't eat your house, but
Right.
yeah, I mean it's a good investment nonetheless. Yeah, it has made me a good chunk of change, and it's a good part of my net worth now. So I'm happy about it. I try to tell everybody, hey, like especially people my age, like mid-20s, early 30s. Like if you don't have a big family where you have like some security concerns, like just looking at multifamilies, consider it, because single families, that you're losing so much money on single families, man. It's crazy.
The multi is definitely a lot better.
Yeah, yeah.
My issue is no one wants to live in them. I show them all the time. I'm like, I mean, this is what you got to do. I mean, and they're not that bad, but a lot of people have this HGTV or like romantic view of housing, especially the first house, and that holds people back.
Yep. Housing, like everything, is gone through like this luxury conversion where everyone's just looking at like, it's not about what it gives you. It's like how nice is it. People really have to decouple that. Like your house is to live in. Your house isn't to like, I don't know. It's not a Rolex, right? It's not a luxury item.
Right.
Yeah, man.
You have to get to a financial point where you can make that luxury purchase where you don't have to worry about the numbers and everything.
Maybe. I mean, I think I think about that stuff a little differently. To me, it's like luxury. I kind of like kill it. Like I've no need for it. So from a personal standpoint, there's like a certain amount of money that's enough, and then everything that you can buy after that is just whatever. Like my car's a 2012. My wife's car's a 2014. We don't pay on it. No HELOCs, like no debt aside from the house. So like
you're
stuff
one of
like
those
that.
guys. Yeah, I get you.
Yeah. Not full Dave Ramsey though.
I was about to say a little Dave Ramsey-ish.
No. And you were talking about Graham Stephen. I agree with you 100%. Like his content is okay, but it's repetitive, and his titles and his clickbait it's awful. Like he needs to rein it in, man. It's really bad. Yeah.
And I liked him a lot because I think he puts a lot of work into his videos and does a really good analysis. But the clickbaitiness is concerning.
It's what works, man. If you go through all of his thumbnails look identical, he reuses titles, and like it doesn't matter to him anymore. I'm sure he just has somebody else doing it, and it's like maximizing the views
YouTube.
and
That's the problem with YouTube, man. Is it's like the people that want to maximize their YouTube are doing that, and I don't think it's good for like the viewing audience or people. Although YouTube would argue, well, that's what people are watching and that's what they're clicking on. But I'm
it's
like,
true. It's true. So mighty algorithm gods. Yeah.
It's funny though. He tilted away from real estate when I kind of stepped away from doing the content because I kind of ran out of what am I going to talk about? Like you could talk about the real estate crash every day. Like I don't know because it doesn't make sense to buy as much. So I don't really know what to tell people as much.
Yeah, I mean that's true. But if I look at people like Dave who've had content for 30 years before it was cool to have content, right? You just get other people like this conversation, or like random people call in, hey, I'm looking for a house.
True.
Ryan, what can you tell me? Or like, should I do this multifamily? My wife is not about it. And they're like, this is how you convince her to do it, stuff like that. Stay kind of fresh, more voices.
That's what I'm trying to do. But, we got 3 people in here, so it's hard to do that. But I'm bringing it back. Let's see what happens.
Have you seen that Caleb Hammer guy?
No.
No? He's blowing up. He's like the fastest growing personal finance YouTuber right now. He had Graham on the show recently. And he just brings in random people and yells at them.
I think I know what you're talking about. He's got like curly hair or something.
Yeah, that guy.
He does some kind of.
He's blowing up, man. He's blowing
Caleb,
up.
What Hammer?
Yeah, Hammer. So he's.
Oh, I've seen this guy. Yeah. See, I guess because that adds like the personal component, right?
Yeah,
like, that's what because people don't care about finances like you do, right? I can tell you're like.
I mean, I listen to your show, so of course I care about it, right?
How you found my stuff is crazy to me. But that's super cool, man.
I mean, you're in the area too, so that was good for me to know that you weren't in like Arizona. I was like, oh, this is a
Yeah.
real thing in my area, you know.
Wow. You never know, man. You never know. Wow. Well, I appreciate you like sharing and commenting and letting me know that, because you could have just not said anything and I was like, never knew.
Yeah, man,
So
you're doing great work. Just keep on pushing, man. For real, we want to see the content. I don't know how many people I can speak for, but yeah, we want to see it. You got 3K subs. I've been subs since 20, so
wow,
yeah,
that's
I'm ready to
crazy.
see stuff, man.
Well, I really do appreciate that, because it's hard to come up with, it's a lot of work to figure out. And I have like a real business to attend to. So, but I really appreciate it.
Fair enough, man. Great stuff, and I'll talk to you on one of these meetups in South Jersey. Just give me the details. I'll be there in the spring.
Definitely, definitely. I'll send you. Do you have Instagram or something?
Nope.
Oh man, I see. I knew you were one of those guys.
There's no DM in YouTube.
I don't think so. Yeah. I'll figure out something.
Yeah, we'll figure it out. Don't worry.
You definitely should come. I'm trying to build, a network of people. So, never know. And it's a good time. We have fun.
Sweet. But all right, man. I'll stay on the stream, but keep doing what you're doing, and have a good time, man. God bless.
Appreciate it. Have a good one. See. Wow, super cool. I'm in awe. Seriously. Because we, my brother helps me with the RD Real Estate podcast, and now we got our real estate team on, doing content. And I feel like I always got to try to motivate people, but I also got to try to motivate myself. And, in this internet world and with Instagram and YouTube and all this stuff, you start looking at numbers and metrics. You post a video, 50 you get 50 views, and you're like, and you spent a couple hours, like, because now I've been paying for an editor and stuff like that, but it's a lot of resources, time, and commitment, and you don't know what's happening. So like that means a lot to me for Expansive Acorn to come in and kind of share that. And again, bro, I really appreciate it. That's really crazy. But yeah, it's hard to stay motivated, and when you're trying to approach this stuff with integrity and trying to actually be helpful. And when I was talking about my why and what drives and motivates me, it's that kind of stuff, because I'm sure he's looked at a whole bunch of stuff. He said he had spreadsheets, but to be able to contribute some kind of perspective, and at least like any nugget or any kind of help or piece of information that could be helpful means a lot, because you actually do make a difference. And I always say that to other people in their professions, where like, you need to share this with people. You need to, give back, or you need to, just offer up what you have to other people, because it makes a difference. So I don't know. And I know we're kind of like derailed, but that's actually like, I do want to do this style of content. And so if I can get the audience bigger and we can have more people on here, we can all learn together through these conversations and everything like that. Until then, I am just reacting and giving my perspective. And obviously we have the RD Real Estate podcast, which is the derivative of what he had watched previously about the NACA house hack video, which formerly that was called Ryan Got the Bread podcast, which I did not name, can't stand that name. And I think that was the Wesley Williams episode. If you guys want to try to look it up, I don't know if YouTube will allow, but if you want to check it out, we had someone from Philly bought a house with NACA, which is, it's complicated to explain, but basically they're a lender, but they lend in a different way than the traditional banks. And you have to go through all these programs and counseling, but it has a really good loan product, 0% down. They even will help you do rehabs, and you can buy multifamilies with it. And he shared his story of buying I think it was a triplex in Philly, and renovating it, and it's just a very relatable story. And that's what I try to. He said Ryan Got the Bread is a great podcast name. It's so pretentious. I can't deal with it. But I see, for the YouTube algorithm, getting people that don't have a following or anything like that isn't helpful for the content of growing as a creator. But I think someone who just went through their first deal, or like Expansive Acorn was sharing his experience in 2020, is actually more relatable, because actually I'm a bit out of touch, because I'm in a different situation than someone who is just graduating college, or whatever they have going on. So it's really cool to talk to somebody who is in a similar situation, different background. I think that type of content is super helpful to people, even more than these big names and stuff like that. So that's just my perspective on everything. Where should we go now? That's interesting. Because, all right, let's get the Graham. Actually, this CNN thing, we're cool. They were talking about office. Well, basically, the premise of what we were talking about was office real estate and how that's going to impact residential housing, what that means for you, basically. Like, what are things to look for? How is that going to affect pricing, interest rates, the banks, and all that kind of stuff? And I think we got to the point of the video where they were talking about some of this office space that is no longer needed is being converted into condos to some degree, which, adding to the housing supply, would bring pricing down, because you add supply, it's going to, and if demand stays the same, price is going to come down a little bit. I don't know if it's going to be that impactful based off of the amount of units, but it's something to look out for. But that would help home affordability, especially in the cities. But let's see where we left off on here and see if we can get back on to what's going on. I can't believe you like the Ryan Got the Bread name. That's so pretentious. Oh my goodness. And I'm broke and dusty right now. So
to take up space in an office building.
What are we talking?
Thanks to new city zoning laws, that's now possible, along with 7 new types of commercial businesses, like animal boarding, hydroponic farms, and pickleball.
Oh,
it's
Jesus.
already happening in South Jersey. This 22,000 square foot pickleball facility was a vacant Burlington coat factory in a strip mall. Regional mall vacancy is at a record high.
Were there a lot of options like this on the market?
Yeah, I think we had more.
All right. What's up with CNN, man? Like, I feel like news has become entertainment. Like, I think this is a cool story, and it's interesting, and it's funny, because what the heck is going on with pickleball? I don't know what it is. It's a dumb name. They need to fix that. It kind of looks fun, though. I don't know. I never played. Don't know. But CNN is talking about office real estate, and they go from, oh, well, they can use it for movies and hydroponic farms and all kinds of, like, what's the reality? Like, that's not what's really happening out here. And so the stories that they choose are for entertainment purposes and not informational purposes. And I guess back to our conversation, with Graham Stephan, his thumbnails and stuff like that, the way YouTube works encourages you to do things that kind of don't serve to inform people, or, I just think it's kind of a problem. And even CNN's doing it. Like, I don't want to get too political on all this stuff, but man, everything's it's not exactly misleading, but they could be informing us better than this versus this pickleball thing. Like, I get it. I get, like, the concept of what they're going for. This is an example of repurposing space. That cool, legitimate. But I feel like they just look for, like, a crazy story to try to make their point, and it's somewhat of a distraction, because what are most strip malls being converted into is what I want to know. Not like stuff like this, even though it's funny. This is in South Jersey, so it's close to me. But let's hear what they got to say. I'm sorry, guys. I'm sorry. You gotta really be careful about media, everybody on YouTube, me, everybody, whoever you listen to, because the intent is a business intent, and you think they're there to inform you. It could just be misleading. Oh.
Than we thought there would be in the market.
Pickleball is the fastest growing sport in America.
What's this have to
Does
do with
that
anything?
mean that the sport needs to find places to play quickly?
The greatest threat to the growth of pickleball is the lack of facilities.
Where are we? They're going to fill
pickleball is a great.
They're going to fill the office space with pickleball because it's growing so big. Like, come on. Like, what is that left turn in the content? I don't get it. I get it. I just don't like it.
Great way to draw people into commercial spaces. This is also happening in Connecticut. The largest indoor pickleball facility will open in an old off Fifth. So that's
journalism.
Saks Fifth Avenue. And we spoke to landlords about what they feel like is going to bring businesses and people back into the office. Perks. So things like outdoor space, better food options, better things to do on your free moments at work. It's a tough time for commercial real estate.
See, that's a good point. That is a good point. Amenities in the office, culture. That makes sense to get people back to work and to be productive and like to go back to work and all that kind of stuff. And you can utilize the space. That's good reporting, but goodness gracious, this pickleball thing got me triggered a little bit.
All the banks are saying something different. These are the lenders, right?
What are they saying?
Yeah, what are the banks
saying? You have someone like Bank of America saying that this is going to be the worst situation since the financial crisis. You have Morgan Stanley saying that this is going to be manageable. You have other banks saying that this is something we need to wait and see. A recession could obviously make this worse. No one's really on the same page right now about what this is going to look like, but at least what we're seeing in major cities, for example, like San Francisco, this is a ripple effect. You have the offices leaving, you have the retail leaving, and then you have fewer people in those cities, living in those cities.
Always nice.
So now I'm going to get recommendations for CNN on my YouTube, and that's horrible. But that's why I was kind of concerned about covering this topic, which goes to what she said at the end is we don't know what's going to happen. Like, I have no idea what is the gravity of, say 15% is probably reasonable once most people go back to work or whatever. 15% vacant units that probably don't need to be there anymore, or say 20%. What does that do to banking? What does that do to the economy? What does that do to cities, the suburbs, housing? I don't know, but neither does Morgan Stanley or Bank of America. So whatever for pickleball, but real question, what's your stance on the fire people, the ones saying ridiculous sums and retiring early, so not even going into work at all after retiring in their 30s or 40s? Oh, I was talking about this too. Well, you're talking about the people that want to fire them or the ones, okay, hold on. Whatever for pickleball, but real question, what's your stance on the fire people, the ones saving ridiculous sums and retiring early, so not even going into work at all after retiring? Okay, so we talked about this on the Artie Real Estate podcast, which is on the other channel now, which that video is coming out in a couple of days. I understand. Well, if you made ridiculous amounts of money, that's different. But kind of what I was saying is I think that there is a large contingent of people, and I talk to my brother about this a lot, where they don't see working hard as getting them anywhere, right? Because especially if they have student loan debt and then they get out and they don't have a good degree and they're not really making that much money. And now with inflation and like if they're renting, like that's eating up 50% of their gross income. So like they don't see the future prospects of anything. And so I feel like they just gave up and only care about lifestyle. And so if they could work less, they're going to work less, even if that means like making less money. The idea that you're going to work really hard and get ahead, for a lot of people, I think a lot of people are defeated. I don't know if I don't want to tell people that, and I don't agree with that, but I do understand that ideology at some point when I look at the economy. Because I was in the military, which I think is a cheat code and something else I talked about on that podcast. But if I didn't go through the military and kind of skip certain steps and gain advantages, and if I did a bad job picking my degree, and then I was stuck in the situation where it's hard to make money, and then the prices of everything go up, and you feel like you don't have a chance. I get why people just throw their hands up, because it's just like, well, I'm just gonna, I don't know, I'm just gonna disappear, disappear from the economy, disappear, it just, I'm gonna work from home. I'll do the bare minimum. I'll take this other job, do that, but it's never gonna. I just think they give up, and I think it's harder now. Like if I was 20, 21 now today, I think I'd have a harder time. Yeah, the Veterans Day thing. Thank you, I appreciate it. 2/5 vacancy is my estimation, but I know nothing. Me neither. Like I don't want to pretend like I'm some economist or analyst. Like I basically just look at the information and then look at what's happening in like a base. I'm looking at what my two eyes are seeing and kind of coming up with a loose opinion about that. So don't ever take my, these are just mostly ideas or hypotheses. So hypotheses. I agree, the 2/5, right? Because that's around where the vacancy is. And based on what I'm noticing about people working from home, it's still there, but it's a lot less. If I was an employer, I would not want people working from home because I don't think it's very effective. But because I think actually the thing about working from home is you can't build culture, and you can't see. I have a different mentality about this kind of stuff because I was in the military where you're actually supposed to care about your people beyond like them accomplishing the mission. Like you would get praised if your soldiers got college credits while they were under you, or they did other things in their life. You would get credit for that from your leadership. So I have that built into my mind where like if people came into, if I had an office, which I would like to have, I would want to build a culture that does more than just sell houses, right? Like I want to like build a community, get education, be home buyer seminars, like teach people, have classes, but within the office, I want people to buy into that culture, because I always look at like Chick-fil-A and I'm like, how do they get people to behave this way? Because their service is so much better and they're selling the same thing. They're kind of a fast food place, and yet their culture and their employees are, they're better. and it starts with culture. So I think that's why office, a lot of these owners want their people to come back. I do think if you can give somebody, some work from home time, like when needed or whatever, I think that's cool. So I think that's what's going to happen. Is that I think we've discovered that work from home is not very effective if everyone's doing it, but I think a hybrid model will work. So that's where I'm coming up with that 20% plus from the numbers that we're looking at. That's what the vacancy rate's looking like, 10, 15, maybe 20%. So I think it's probably somewhere like that, 20, 15%. Is that big enough to have a giant impact where we feel it in the economy? I don't know, but I think your cities definitely would change. And I do think having some more housing probably would be kind of a cool thing. Yeah, see Popeye. He said, expansive acorn culture is true, but it's up to the employer to build culture. Absolutely. Well, having people at home, which is what the workers in a large part want. Yeah, I think it's hit or miss with that. Because I think people think they want to be home, but I think it's bad for your mental health to stay at home and work. I think people feel like they want to do that, but that's because their office culture is bad. And I agree that the employer is responsible for building the culture. Absolutely. I wonder if companies will understand that and cater to that a bit more than they have. Not saying that they don't. Like the biggest companies, Google, Apple, and all that, spend a lot of money on their company culture and amenities for their people, for their employees. So I wonder if that does trickle down because of the realization, like, oh, now no one wants to come to work. How can we get them to come to work from a capitalist perspective, right? Like, I think a pure capitalist might say it probably would benefit me to invest a little more in amenities, culture, environment, and stuff like that. So that's kind of what I'm thinking about. Expansive acorn, let's be real, Popeye's service is better than Chick-fil-A. The fear makes it taste better. Popeyes in Philly is crazy. It wasn't a Popeyes. I think it was a McDonald's on in North Philly, kind of by a Temple, but a little bit higher up. Maybe it was a KFC. They had bulletproof glass. You had to put the money in the drawer. I had never seen that. I said, goodness, Philly is wild. So I went to Temple, which is in North Philly, and they've like really improved that area, and there's a lot of development there. But then if you keep going further north, it gets a bit hood. But yeah, I don't know. I don't know why I would even say that. Commuting sucks all around. Let's be real. Yeah, commuting does suck. That's why it would be interesting if you had mixed use, which that I did talk about zoning in one of my other lives, and I think it's a really big issue. I think cities are probably better with it than the suburbs. Suburban zoning and planning is awful, and it's from the 1940s and needs to be updated. But if you can live, if there's mixed use housing and office space within those buildings, I think that's kind of interesting. Now to think that you're going to work in the building that you live in is, I don't know how realistic that is, but I think that actually would help with the commutes. And I think mixed uses is the future. I think flex and mixed use is way better. Expansive acorn for sure. Bulletproof glass is a real thing. Surprises all the suburban kids when they come to Temple, North Philly. Yeah, I'm like, should I be here right now? So that's something. Let me bring up these tweets that Santiago, my friend, who is in medical sales, but he's a really smart guy. Medical device sales, I believe that's what he does. Super smart guy. Let's try to zoom in on these tweets. I'll read them. So he sent me these tweets. I have not verified this information, so I may be spreading false information, but it feels right. Because if you guys didn't know, San Francisco is like going down the tubes from their policy, plus Silicon Valley's kind of moving around, and so there's a lot of shakeup with the North San Francisco Bay Area. So here's another San Francisco real estate office disaster as the bad news keeps coming. A 100,000 square foot office building, 55 New Montgomery Street, recently sold for $15 million, which equates to $150 per square foot. This is incredible given the building last sold for $64 million or $641 per square foot. Oof. The $15 million purchase price is a 76% discount. I was about to try to do that calculation in my head. Thank you for bailing me out. To what it last sold for in 2018. So from 2018 to whenever this tweet was, which was this year, That's a massive drop. I think a lot of this has to do with San Francisco specifically and their local market, because real estate is local. But it will be interesting. San Francisco might be the epicenter for this kind of stuff. Like, what the population's moving out, like what's going to happen to the city? How is it going to reinvent itself? Because I think it is an opportunity to make a pivot. Hopefully this is where government and all that stuff comes into place. Like, are they going to, like, what policies do they implement to provide space for revitalization? Because San Francisco is a beautiful city. It's a great location. The weather is pretty awesome. And that area overall, Napa Valley, Sonoma County, all that kind of stuff out that way is really nice. So it'll be interesting. We should keep an eye on it for those reasons. The lender and new owner, Cross Harbor, is the latest lender to seize an office property in San Francisco. The sale comes after the previous owner defaulted on the $71 million loan. The remaining loan balance was more than $65 million. So that's the thing. We've seen banks fail. Some of the regional banks fail. And then when they're taking $65 million hits against the loan, I am curious what that does in the banking system, which can affect housing in general. But to really affect you guys, it would have to be like a large impact. So I don't know. I don't know the economies of scale or the not economies of scale, but the scale of like how much has to be lost before the banks have to react in a certain way. Here's another tweet that was sent to me. Oh, this has to do with housing. So we're pivoting a little bit, and then we're going to get to Graham Stephan with this reverse market crash, which I have not pre-watched, and we're just going to go through it and see. The Kabasi letter, again, I don't know nothing about this. Homes, and this is something that I have been seeing. That's why I wanted to talk about this. And this is a lot of my realtor friends have been talking about. Homes listed for sale are beginning to see a significant spike in price cuts. I can attest to this. We are seeing that from the data and from anecdotal evidence in my local market here in Burlington County. In October, 25% of the sellers cut the price on their homes, according to Reventure Consulting. So don't hang up on the numbers per se, because like, how are they getting the numbers, blah, blah, blah. But I think this is definitely happening at some level of scale that is notable. This is up sharply from the 17% seen last year at this time and the all-time low of 8% in 2021. Still, home prices are only down 6% from their all-time high. So I have a perspective on this, because we're seeing sellers cut the price on their home at around 25%, something like that. But prices are only down 6%. And what's happening, and I know this because we have our real estate mixer events, and I talk to a lot of realtors now that I'm a broker myself, and have been trying to stay more in touch with what other agents and people in the industry are thinking and feeling and noticing, is that you have to continuously adjust to the market, because it's changing in real time. When interest rates change, it makes a really big impact on what's happening in the market. So for example, if the rates drop significantly, we're definitely going to see prices go back up. It's going to be competitive. It's going to be challenging. I think that happens at around 6% or 5.5%, where if you sell your house and you're at 3%, 2.25 for expansive acorn, who was putting extra money down and doing all that kind of stuff and super savvy, if you wanted to upgrade your house at that point, maybe it makes sense, right? So but these things, real estate happens slowly. So some of their agents will be giving advice from 2 weeks ago when the market has changed. And now they're in a different market, and they're still telling clients to do certain things, or they're thinking pricing is a certain way. So you could walk into a house and recommend a price, considering that you still think it's a seller's market, and it's not as strong of a seller's market. It's a bit balanced right now. So if you increase your price too much, or you list too high, now you're having a cut to chase the market back down because you misread the situation. Expansive Acorn, it's been fun, bro. Keep on the grind. Love the content. Thanks for the direct advice today. I will look forward to the pod episode coming out. Good night, man. I really appreciate it. Thank you so much for your feedback, and thank you for providing your sharing your story and perspective, and just helping me out and hanging out, giving me some company while I'm struggle streaming with not that many people on here. But I'm going to continue to do it. And seriously, man, like, I'm going to think about this conversation for a long time for you saying that, you know, it was helpful in some kind of way. And I really appreciate that. And the weight of that is not lost on me. So I appreciate you for real. So yeah, I think that's what's happening here with the price cuts. The price cuts aren't exactly saying that, oh no, the market's going down 25%. It's saying that agents are having to adjust and the market has shifted. But because no one wants to buy or sell a house and the activity is so slim, just like stocks, if the volume's light, it's a bit of a spooky signal. And you should be careful at looking at the data when volume is low. So, you know, the market has shifted, but I think we're at a new normal for now. Now, the most important thing is interest rates, because if rates go up anymore, I still, even if rates go up, I don't know if we're going to see pricing change very much, just because, again, there's just so few buyers already. I don't think it's going to make a difference to them, but the sellers are going to have to sell anyway. So we'll see, though. I don't like making predictions, but we'll see. So let's get to Graham Stephan. Let's get to Graham Stephan. Okay, first of all, this is his thumbnail. Okay. And then it started the reverse market crash of 2024. So he's saying that your money is going to go on fire with this picture, you know, and he looks upset. And this is a nice watch. But and he said it started. So let's see if this reverse crash started. What does that mean? And this is a response to a valuetainment video, which Patrick Bet David is one of my favorite people, and I think is a really great role model, especially for men out there. But he's a really smart guy, so you should check out valuetainment. Anyway, let's get into the video. Let's see. Let's react. Again, you guys can comment or call in or whatever, or give your perspective. We could do Q&A, and this is an interactive show, so whatever you guys want to do, let me know.
What's up, Graham? It's Guys here. So when it comes to the markets, we've got some good news and some bad news. And depending
on fair use,
where you stand, you're about to either make or lose a whole lot of money. Case in point, this video from Patrick.
You see how bombastic that was already? You're going to make or lose a whole bunch of money. Like, are you really? Or are you like, why? What? Like, everyone? I don't think I'm going to make or lose a bunch of money based off of this, but maybe he knows something I don't know. All right. So look, Grant Stephan is cool. I think he's provided a great service, and obviously he's really great at YouTube and getting clicks and views and all that kind of stuff. And his videos are really good and they are informative, but I think statements like that are problematic.
David, who describes the scenario you probably haven't thought of until now, a reverse market crash. This occurs when prices suddenly balloon upwards, allowing some to build a substantial amount of wealth while everyone else gets left behind. After all, we already saw something similar happen after the 2001 dot-com bubble, when surviving tech stocks turned into 10,000% gainers, or the 2008 mortgage crisis as investors scooped up foreclosures, and most recently in 2020 before asset prices doubled or even tripled. So given the fact that most...
All right, so that's something, I wrote a blog post actually about this recently, and I've been talking about this a lot. I've said it on some of the older Artie Real Estate podcasts, and I said we are moving to an economy of asset owners and everybody else. And if you're not an asset owner, you're going to be broke and dusty, and you're going to really hate it, and it's going to suck, because the value of everything is going up. Assets, sustainable businesses, stocks, equities, real estate, sports cards, artwork. The value of all that stuff is going way up. And if you don't own any of it, you're going to be left behind, because the people that are getting the benefits of this are going to so far leave you financially that you will never be able to purchase or own anything, and you'll never be able to get in the game. Therefore, these people who own the real estate, you're going to rent from them. You're going to be paying those people, and you are going to have a hard time getting ahead, even if you have high salary. But if you have a low salary, you're definitely screwed. So that's why this is important. That's why you need to own something. And again, I know, look, I'm a realtor, and so I get it where they're like, oh, you're biased. But seriously, I don't care if you buy real estate or stocks or whatever, but you need to own assets that appreciate in value, because again, you will be left behind. And in my mind now, I already posted a clip about this, but I just can't emphasize it enough. You must own assets. You must, or you're going to be broke and dusty.
People completely miss out on these record-setting reverse crashes. Let's talk about exactly what's going on, what you need to look out for, the biggest mistakes that people make, and why Patrick believes this next decade could provide some once-in-a-lifetime opportunities. As soon as you reverse the like button for the YouTube algorithm and subscribe if you haven't done that already, since it does help with the channel tremendously. I'm also going to be linking Patrick's video down below in the description for anybody who wants to check it out. And now with that said, let's begin. All right, so to start, according to Valuetainment, all of this is part of a vicious cycle where the rich get richer and the poor get poorer. After all, according to this chart here, the middle class is shrinking at an alarming rate. As you can see, middle class wealth has shrunk by nearly 50% during the same time that upper income wealth increased by almost 30%. Separately, the same study...
I do have to say, I've been saying this for a long period of time. The middle class is dying, and we're going to have a barbell economy. So if you think about a barbell, it's got the grip in the middle and then two balls on the side. And so either you're going to be poor or you're going to be rich, and there's a very thin middle class that is also probably struggling. But either you're on the upper end of the middle class where you're going to get rich, or you're on the lower end of the middle class and you're going to get poor. There's going to be very little middle because of the way the economy is going. Politics, all technology, everything is causing this. And so again, I must stress, do whatever you can to be an asset owner of some kind. Own things that are valuable and go up in value.
We also found that the median household wealth had yet to recover after the 2008 financial crisis, with the typical American family having a lower net worth in 2016 than they had in 1998. On top of that, a recent report also discovered...
So you see that Americans are getting poorer. We're losing, the average American is losing. Inflation, eating their money. If they don't own a home, definitely eating their money, losing money. And so again, you got to get in the game.
That the total population of the middle class here in the U.S. has dropped from 61% in 1971 to 50% in 2021. And if you thought that was bad, the average wealth of the middle 40% had dropped by 7%, or $27,000, since March of last year, which equates to one of the largest drops on record since the 2008 financial crisis. As far as why this is happening, when you really get down to it, wealthy people have the disposable income to save and invest. And when interest rates are lowered or inflation is high, those assets are the ones that go up the most in price. Hence why the richest 1% make twice as much as the rest of the world. So what does this mean for the future of a reverse stock market crash? And how do you make sure you don't get left behind? Well, according to Patrick, all of these...
Oh, I'm sorry, everybody. I am broke and dusty, and I don't have the premium.
Crashes happen for roughly the same reason, and here's what they are. He first starts by giving an example of Germany. In 1914,
Ryan doesn't have the bread.
4 German marks equaled $1, or basically every mark was equal to 25 cents. However, shortly afterwards, Germany lost World War I. They were forced to pay tens of billions of dollars in reparations for civilian damages, and as a result, their economy was in shambles. This meant that they had to print so much money that by the time they were done, instead of it taking 4 marks to buy $1, it required 1 trillion marks to buy $1. In fact, inflation occurred so quickly that in 1919, a student ordered a cup of coffee at a cafe. The price on the menu was 5,000 marks. He had 2 cups. When the bill came, it was for 14,000 marks. If you want to save money, he was told, and you want 2 cups of coffee, you should order them both at the same time. After that, we have one of the most well-known reverse crashes in history, and that would be Zimbabwe. This was the country who was famously known for printing $100 trillion notes.
Yo, we got to talk about Africa. But I'm going out there January, February, so I'll be vlogging. I'll be doing all that kind of stuff. I'm looking at buying land, looking at condos, and just the lifestyle and all that kind of stuff. Zimbabwe is Southeast Africa, basically in that region, and they like took all the land back from the whites. So they that's what caused this a lot. So just as context, because I don't think he's going to get into that. But decolonize Africa.
That was worth only 40 cents here in the US. How did this happen? Well, their country was extremely mismanaged and subject to political exploitation. In addition to that, their government printed vast sums of money to finance military operations and ramp up food production. But as it turned out, they lied about this and underreported their money printing activities by $20 million a month, while subsequently calling inflation illegal. This led to a complete loss in confidence of Zimbabwe currency and caused all of their asset prices to skyrocket. Or how about another one? We got Argentina. In fact, just a few days ago, it was found that Argentina's inflation rate came in at 140.
Oh, and the thing about the women from that area are super beautiful. Zimbabwe, Southeast Africa, East Africa. Woo! Shout out to them.
2%.
Back to real estate.
And if you thought that was bad, since 1950, the average...
Oh no, my camera. I gotta fix it. Hang on.
Inflation comes out to 206% per year. How? Well, to start, they've defaulted on their national debt almost a dozen times. They printed so much money that in the last 10 years, the Argentine peso has lost 99% of its value against the dollar. Confidence in their currency is also falling, resulting in less economic investment and even worse outcomes. However, because of these high currency devaluations, their stock market has increased by 1,650% since 2020. In addition to that, there's also Turkey, record high inflation, record high stock prices. In Iran, inflation reached a high more than 50%, and shortly after, even higher stock prices. And finally, Patrick mentions that even Venezuela saw the exact same trajectory as inflation correlated with a reverse stock market crash upwards. Because of that, by all measures, Patrick implies the same thing could also be happening here in the United States. So could it? Well, before we answer that question, I just want to say that if you want additional details that I'm not usually able to provide here in a YouTube video, feel free to check out my newsletter. It's down below in the description, or it'll be the pinned comment. Sometimes I just have to cut these videos down on YouTube to save some time, so I highly recommend you sign up for it. If you want additional context or sometimes more information or bonus information, the link is down below and it's totally free. Anyway, as far as whether or not this could happen here in the United States, it's really important that you understand the difference between nominal and real rates of inflation, because I promise this is going to help explain a lot. See, on a broad scale, most of us are familiar with nominal interest rates. This is simply the interest rate set by the Federal Reserve, and it affects everything from how expensive a mortgage is, how much you get paid in a savings account, or the yield on a treasury. Think of this kind of like if the Fed keeps interest rates at 5.25%, then the nominal interest rate is 5.25%. Although when you really get down to it, that's still not the entire picture. That's because interest rates are often affected by the amount of inflation in the economy. So the real rate of inflation is when you take the nominal rate, subtract inflation, and what you're left over with is a much more reliable indicator of what you're actually paying. So this becomes the real rate of interest. Now, even though you might certainly think that today's interest rates are high, when you look back historically, you'll see that over the last 20 years, when accounting for inflation, they've actually been incredibly low. For example, in April of 2001, real interest rates were only 2.2%. After the 2008 Great Financial Crisis, real rates briefly went negative. This was even more pronounced during the 2020 shutdown, when real real rates went as low as 0.5%, meaning you effectively made $5,000 a year in profit for every $1 million that you borrowed, which is insane. Of course, in terms of how this relates to the overall context of a reverse market crash, Patrick makes the point that every other economic catastrophe was eventually induced by periods of negative interest rates, like Zimbabwe, Argentina, Turkey, and Iran. Patrick also makes the point that in all of those scenarios, there's an abundance of borrowing and money printing, the government steps in to regulate and enact price control, and there's a loss in confidence in the economy, somewhat like we're seeing here. So in terms of whether or not this is actually something to worry about,
well, you said it started in your title. What are you talking about?
here's what I think. In terms of the middle class actually shrinking, first of all, some people actually interpret this chart completely differently. Like according to the Brookings Institute, the middle class is not disappearing, it's just getting better. As they say, the bottom 1/5 has 25% more income in 2007 than they did in 1979 when you account for government transfers, the value of health insurance, and the decline in household size.
The lifestyle of someone that doesn't make a lot of money is overall better than someone's lifestyle that didn't make a lot of money in the 80s and 90s. The problem is there's a lot more people who don't make a lot of money on today's standard. So that's not a good thing. Just their quality of life is higher, but in their ranking or their ability to do things in society is lower on the scale of our society. So yes, they have flat screen TVs, but they're broke and they can't do nothing. And they're, if you compare them to all the other people in the distribution of people within the income range, they're worse off.
Increased by 37% throughout that exact same time frame, and that the middle class of today is a lot better off than the middle class of the 1970s when you account for government programs and assistance. A completely separate study has also confirmed.
Who wants to be on assistance and all that stuff though? And then you got to fill out all these forms, and if you make too much money, then that's a mess. So I don't know how you're using that as like a positive thing, like, oh, it's better.
That yes, the middle class is shrinking, but only because they're moving into higher income groups, somewhat like you see here. Even though this might sound incredibly difficult to believe, objectively, there is some truth to these findings. Like from 1971 through 2021, the middle class shrunk as a disproportionate amount became upper class. Now sure, lower incomes did increase, but not as much as those who wound up doing even better. It's also true that
I'd have to see what they're classifying in the different classes, because I think if you make $100,000 a year, you're middle class now.
while the United
It used to be you were doing real good.
States has the smallest middle class of similar nations, we also have the largest affluent class and poverty class, suggesting that either people are just getting richer or they're getting poorer. Yes. That's why, even though we could clearly see that aggregate wealth is declining for the middle class, a portion of that drop is simply due to people becoming wealthier and making more money, at least depending on how you interpret the data. Second, even though countries like 1920s Germany, Zimbabwe, Argentina, Turkey, Venezuela, and Iran were absolutely ravaged by high inflation and soaring stock values, let's put that into perspective with the United States. For Germany, their market increased 600% in 3 years, but relative to the US dollar, their market actually declined by over 80%, completely negating any profits that were seemingly made on paper. Now, Zimbabwe is even more extreme. Their market increased by 1,000 to now 553,000. But again, relative to the US dollar, their market has actually crashed more than 90%. The same thing also applies to Argentina. Again, you see a huge stock market spike, but that actually equates to a 61% loss in purchasing power when converted to US dollars. And something similar could also be said about Venezuela, Turkey, and Iran. In each of those cases,
are they saying, like, did the rich people get real rich though from the hyperinflation? The people that actually own the things, or did they degrade in their value too? I don't get it.
Stock values were not correlated with higher increasing purchasing power. Instead, even though it helps to have your money in appreciating assets, they still all lost value when compared to what you could buy in US dollars. In addition to that, almost all of those countries were severely impacted by war, corruption, famine, and or sanctions that severely impacted their ability to quickly recover. Of course, that's not to say the United States doesn't have its own problems, because we have a $33 trillion national debt. Parties are becoming more and more politically divided, and inflation remains somewhat higher than the Fed would like, even though it's coming down. But it's also worth considering that both inflation and interest rates have been higher in the past. GDP has been incredibly consistent for the last 50 years, and the US holds the reserve currency.
Yeah, so that's one thing I don't know what to make of, is that if you look at the interest rates for mortgages and things on the history, they're not that high. So how do we live with this current interest rate? Because right now it feels like we don't know how to live with it. But if we're going to rock at 7% for a 30-year mortgage, or 7.5%, what's that mean for everyone? And I think we're still grappling with that, because I'm not really sure.
Status of the entire world. Now, sure, anything could happen, and to expect this to be the case for the next 200 years without any interruption could be quite a stretch. But in the big picture, I don't think it's a fair comparison to infer that the United States could face a similar outcome to other countries that see 200% annual inflation and a 10,000% reverse stock market crash upwards. Systemically, I just think there's so many fundamental differences where if that were to happen here, we'd have much bigger problems to face, and the only things of value would probably be guns, ammo, and food. Of course, I don't want to imply that this can't happen here.
Make sure you have all three of those things.
In the United States on a smaller scale, because in a way it's already happened. Inflation increased, interest rates were lowered, and people either made or lost.
Yeah, I used to think those doomsday preppers were crazy, but then I seen them burn a couple cities down. And imagine you get a snowstorm that knocks power out for, say, 10 days. Some people might not be ready. They might need some food. And what if the stores are closed? You know, what if the infrastructure goes down? I know I sound crazy right now, because I'm like, man, ain't none of that going to happen. But the older I get, the more I'm like, the world could fall apart. And no one thinks it's going to fall apart. And then it's too late. And now you're not prepared. So, you know, I'm not a crazy doomsday prepper, but am I going to make sure I have some water and some supplies and some firearms? Yes, I am.
Lost a lot of money. That's why I tend to think that it's not so much of an income gap that's contributing to the inequality of wealth, but instead an investment gap. For instance, when the Federal Reserve first lowered interest rates and stocks plummeted, the ones who could take advantage of that the most are the ones who already had the investments and disposable income to begin with. Everyone else was left out while inflation reduced the purchasing power of their money. On top of that, wealthy investors also tend to have the willingness to take up.
So right there, that's what happened. Okay. When prices of everything went up, the people who owned the things that the price went up didn't have to cry about inflation. And the people who got paid salaries got screwed. That's why you must own assets. That's why you have to own something that goes up in value.
More risk for higher returns because they could afford to ride out any short-term fluctuations in price. In comparison, someone working paycheck to paycheck can't afford those risks, and any extra income they have is taken up by higher-priced goods that are becoming necessities. That's why, given all of this, as far as what you could do to put yourself in the best position possible to come out ahead, the boring basics still hold true. Save more than you spend, invest in a diversified portfolio long-term, don't panic sell, stay invested, and focus on what you can control, like your overhead, job skills, your employability, and whether or not you follow my newsletter down below in the description, because that's totally free. And also, always, if you appreciate the videos,
I appreciate the video.
Using a paid.
But see, this is my problem with him. When you watch that video, I mean, he's just talking about what might happen, but it says it started the reverse market crash of 2024. And let's look at some of his other videos here. The Fed pauses rates, housing declines. That's fine. It's over. The middle class is disappearing. And then in his other video over here, he's like, oh, I don't know if it is actually. I don't know if it actually is. Like, what's your opinion, bro? Can we see some more thumbnails? Look, these are the same thing. The housing market is in serious trouble. Okay. But then he'll be like, the housing market's doing great. And you're like, what? Oh, yeah, here we go. Look, the housing market is getting destroyed. The housing market is in serious trouble. Oh, I want to know why he stopped drinking alcohol. It started the reverse housing crash of 2023. What? He did a video before about this. Wow. The worst housing crash just started. Minus 80%. Guys, this is YouTube's fault because I don't have these type of thumbnails and I probably won't get the type of views and all that as other people. And I know you could sound salty about it, but I just, I don't think this is good. Look, don't buy a home in 2023. Sellers panicking. The Fed just crashed the market. Major changes explained. A warning for the 2023 housing market. Blah, blah, blah. Fire. Yeah. So I don't like that. I just don't. I don't like that style. I like Graham. I think he's a smart guy, does really good on YouTube. He gives actually that's a good video. I just don't like the titling and thumbnails and the way that it's presented because it's misleading. And I think that's not good. So today we talked about WeWork crashing and how do people raise money for a business that doesn't work? I don't get it. I know a lot of business owners that if they got more money would do a good business. But you got to go to the right school, you got to say the right things, you got to know the right people, and we need to build a community to be able to do that. That led us into office real estate, where we're seeing big vacancy, mostly due to remote work. These businesses, or they don't need as much office space. They are trying to renegotiate leases. We're seeing in certain cities where companies are defaulting on their loans because they can't lease out their spaces because of these vacancies. We're seeing maybe some of those units are being converted into residential. How is that going to impact the market? We kind of covered my thoughts on, what might happen as far as the office real estate crash. And I don't want to say crash per se, but there's a flux with office real estate, and we're going to be interested to see what's going to happen with that. We talked to Expansive Acorn, who, was a subscriber since 2020, watched a video about house hacking with the Knacker program on a triplex, and he actually purchased his own triplex and has been pretty successful and shared his experience about it. And I thought that was super helpful. So shout out to Expansive Acorn. And yeah, man, that's super, super impactful for me because you said some of my content helps. So I appreciate that. And I kind of gave my point of view on if you're 30 plus and you have a skill, I think you should share it. I think you should share it to people. And that's what I'm trying to do here. I'm sharing my perspective. I don't have all the answers, Sway. I definitely don't.
How, Sway?
I don't have the answers. I don't have them.
How, Sway?
But I share my perspective, and I'm very clear that it's just my perspective. And I always give a little bit of my background at the beginning of the video. So we did that. And then we talked about the reverse real estate crash and Graham Stephan's fear-mongering thumbnails and titles, and the fact that if you don't own anything, you are going to fall behind. And that's it. I'm going to try to do these lives Wednesday nights at least. You'll probably get some on Sundays, but I'll do them when I feel like hopping on. For now, If we develop a following, of course, we'll change. I want to do Q&A. This is a interactive show. So in the future, as we grow our audience, we want to kind of go over whatever I'm qualified to talk about, real estate, business, marketing, even YouTube, social media to some degree. Although, my page is a little dusty, but we're going to get better. And also I have an Africa trip going to Kenya, where I'm going to be looking to learn about real estate and do some real estate out there. So I'll be sharing my experience with that. That'll be coming up around my birthday. Hopefully I can make it out there in time, depending on what's going on. So I appreciate you guys. Thank you again, Expansive Acorn, for hanging out with me for so long and providing your perspective. I'll see you guys later. If you have